University of Malta. He continued to excel in his studies with a Master of Science in Banking and Finance from the same institution. Furthermore, his thirst for knowledge led him to pursue a Master of Philosophy in Management at UCAM from Spain, followed by a DBA in Business Administration also at UCAM. Desmond's professional trajectory is a testament to his dedication and prowess in the financial realm. Currently serving as the Senior Treasury and Portfolio Manager at Medina Asset Management. He manages portfolios valued 50 million for the clients. His responsibilities include creating and maintaining discretionary portfolio tailored to clients' investment policy statements, fund houses and transfer agents, and conducting in-depth research on mutual funds, ETFs, and individual stocks. An investment committee member at Medina Asset Management Limited, he plays a pivotal role in strategic decision-making. In addition to his role at Medina, Desmond has been a successful independent investment consultant and real estate investor and property manager since 2015. His past roles include serving as a risk manager, a junior dealer, and an assistant broker in the motor and personal lines department at Island Insurance Brokers Limited. Desmond's proficiency extends beyond his academic and professional achievements. He is well-versed in various financial platforms and tools, including Microsoft Excel, Thomson Reuters Acorn, Interactive Brokers Trader Workstation, Morningstar Advisor Workstation, and eViews. Fluent in English, Maltese, and Italian, Desmond's multilingual abilities contribute to his international reach and impact. In addition to his practical experience, Desmond Hilly is a published author in the finance field. His research article, Active versus Passive Investing, an empirical study on the US and European mutual funds and ETFs, published in a prestigious journal, showcases his dedication to advancing knowledge in the finance industry. We are honored to have Mr. Desmond Pace share his profound insights and expertise with us today at UniAthena Rendezvous. Please join us in welcoming him to the stage as we delve into the world of finance with one of its foremost experts. Over to you, Desmond.
First of all, I would like to thank you for the kind introduction. Thank you a lot, and also for helping me in doing this presentation. The whole team at UniAthena helped me a lot. I gave them the draft presentation and they came back with a lot of improvements. So I really appreciate. Thanks a lot for that introduction. So we can basically start immediately. So the world of investments, we will try to outline the basic investment concepts. We will also mention some investment options and strategies so that each and every one of you can do informed decision making when you are investing. And also we will mention and outline the importance of long-term financial planning in investing. So, understanding investments. When an individual, an investor, tries to invest, basically, he will usually have a sum of capital, and of course, he invests with the intention that he will make more money. This is not always the case, but that's the main objective for investments. But in the short term, especially, investments can go down in value. Regarding investments, each and every one of us here present today will have different objectives because we are not in the same circumstances in life. So for example, if you have a pensioner, and you compare a pensioner with someone who just started his first full-time job, of course, they will have different objectives. The pensioner would have probably a lump sum which he accumulated during his working years. So he will probably depend on that amount. And of course, probably he would want to take less risk because obviously he has less time compared to someone who is, let's say, 22 years old, starting his first job. On the contrary, someone who is young will have a longer term horizon, so he can increase his level of risk. And so by increasing the level of risk, usually generate higher returns. But in the short term, of course, you are risking, you have a larger probability that your invested sum will decrease in value. But as we will see, that is completely normal, and that is completely normal to happen. And we should be mentally prepared for when that happens. Basically, there is a quote in finance that in investments, probably it is the only industry where when there is sale, meaning when the investments fall in value, it's the only, imagine it's a shop. Usually when there is a shop and the shop owner decreases the prices, more clients will come in to basically take advantage of the more competitive prices. But in investments, usually, because people will be afraid when investments decline in value, usually they sell. So that's why I'm saying this is probably an anomaly, because usually when prices fall, you would want to take advantage of that discount. But in investments, we see that it's a total opposite. It is normal, of course, because when there is fear, for example, a new war started or there is a financial crisis, people will sell and they won't care about the value of their investments at that time, because obviously people take decisions by fear and greed, basically. So what are investments? Investments, probably you all know the term, what an investment is. An investment is something which you hope that it will increase in value. That's why it is an investment. Otherwise, if you buy something and it will decrease in value, for example, a car, there are some people who use the term, I invested in a car. Okay, you can use that, but you are you are naturally investing in a depreciating asset. So that's not a good investment for sure. So by investments, we usually refer to assets which increase in value over time. And of course, by increasing in value, you can basically achieve a number of objectives in life. For example, as we said, someone who just started his first time full-time job, he knows that people are not programmed to work forever. So basically, he will start saving, maybe for his pension or at least in a bank account, although it's not a good idea, because as you probably know, time value of money and inflation basically will eat of your sum at the bank, so you need to invest it. So basically, it's important that we invest, because during our lifetime we will have different objectives. So here on the slide we have retirement, we have education. Some parents will start for example, saving for their children's education from a young age, or even for buying a home. But there might be other reasons. Here, we just mentioned the main ones, for instance. So yes, investments will help you to achieve those objectives. Moving on to what are stocks. So stocks or shares or equities, these are the same term. They mean the same thing, but basically, when you buy a stock or a share or equity of a company, you are becoming an owner in that company. And in order to buy a stock of a particular company, that company has to be a public limited company, because you can buy its stocks only if the stock trades on a stock exchange. There are companies which are privately owned, and we cannot have an ownership in those companies, basically, because they are privately owned. But here we are referring to public companies. For instance, like Apple, probably you know about the company Apple, or Facebook, or Google, Tesla. There are many companies. These are the largest ones, basically. Microsoft. Zoom, we are using the program right now, so to do this webinar. So basically, these are all companies for which you can buy their stock and essentially become an owner in that company. And of course, when you buy a percentage of this company, you will have some benefits, like receiving dividends. Basically, before you receive dividend, the company has to decide whether to distribute a dividend. Dividend is like a distribution of the profits, basically. So, key points about stocks. So, why do we buy stocks, essentially? Of course, we want to make sure that we buy stocks for companies which are successful, because that's the only way that we can do positive return. If we buy stocks of companies which are not going to be a success, that's not a good investment. But as you know, this is not easy, because we do not have a crystal ball and know going forward what exactly is going to happen. Because as you might imagine, in the past, there were companies which were at the peak of their performance. For instance, you might recall Nokia phones. They were like the Apple of today, Nokia, but they didn't invest in smartphones, basically, and they lost the market share. So it's not easy to know which companies going forward are going to outperform the market, essentially. So that's always challenging, even for us professionals who work in this industry. But as you will see later in the presentation, I will provide you with a trick of the trade, basically, how we can choose the best stocks. So here are the key points. We are saying potential for capital appreciation and dividends. Yes, when we buy a stock, let's say we bought Apple shares, we will buy it because if the share price, let's say it is $100, we hope that the price of Apple from 100, it will increase, let's say, by time to 200. I'm inventing now. So I'm saying that I hope that it will double in value. You might see it that this is too far-fetched, but if you study the stock market, you will see that from time to time, very successful companies not only double in value, but they generate more than 1,000% return. So doubling in value, it's not something which is rare to happen. And as we mentioned, when buying stocks, we do not only buy for capital appreciation, but some investors might want to have dividends. So dividends, as we said, they will be part of the profits. It will be distributed to the shareholders. So basically, you will receive part of the profit because you are a shareholder. The second point, price fluctuations. Yes, stocks, since by their nature, for instance, when you have dividends, they are not entitled to distribute part of the profits as dividends. So there is more uncertainty. Hence why stocks are usually more volatile in price. So you might buy Apple shares at 100, and the day after the price falls 10%. Then 2 weeks later, the price increases 20%. So these are normal fluctuations. But if you invested in crypto, for instance, you will see that it is much less volatile compared to Bitcoin and Ethereum, for instance. The third point, research analysis are important when selecting stocks. Of course, since you are buying individual stocks here, you need to know what you're buying. You need to understand the financial statements of the company. And apart from that, you need to have you need to have some idea where the market is going. For instance, this year, there is a company who does graphic cards. It's called NVIDIA. And they include, this year, the market performed really well because of artificial intelligence, basically. And NVIDIA was one of the stocks, one of the companies, which included AI in its graphic cards. So who knew that before actually made a lot of money because it was one of the top performing stocks this year, NVIDIA. Yes, benefits. Benefits, we are saying here that stocks can provide capital appreciation if they perform well. As we said, some companies double in value, triple, and more, essentially. The most successful companies like Apple, Amazon, who bought these companies before they became popular, made a ton of money, basically. But the challenge is knowing beforehand, which is very difficult, and keeping that investment for some time. So you have to be patient as well. Second point, opportunity to participate in company success. Yes, as well. And liquidity, the third point. When we mention liquidity in investment, it means how fast you can turn that investment into cash, basically. So a highly liquid investment, it means that it's highly more easily to change that stock into cash, to sell it, basically. Because if I mention, I'm from Malta. So Malta is a small country. We are an island just below Italy in the Mediterranean Sea. Our stock exchange is relatively small. So if you have a local stock, for instance, it is not always easily to sell it. You might have to wait some days. On the other hand, if you buy Apple shares, you can buy it today and sell it 1 minute after, for instance. So not all markets have the same element of liquidity. So liquidity is how easy you can buy and sell stocks, basically, without having to wait. So the risks for stocks, the main risks are market volatility. So as we said, stocks can lose in value. Last year, for instance, if we take the Nasdaq benchmark in the United States, the Nasdaq benchmark when we say a benchmark, it's not one company, but it is a reflection. It's an index of a set of companies. And this benchmark, basically, it's more technology related companies. Last year, it lost 33%. But if you see some of the underlying companies, some of them lost more than 33%. So yes, it can be very volatile, and it can be volatile on the downside. So when it goes down and it's volatile, you lose money. But it can be volatile on the upside as well. And upside volatility, you want that, because the more it goes up, the more you will make money, basically. The second point, risk of losing your entire investment. If the company performs poorly, yes, if the company goes bankrupt, especially, and there were cases where companies went bankrupt, you can lose all the value. If you invested 10,000 in one company and that company goes bankrupt because of a fraud or poor investment, or maybe it just lost a lot of money because it didn't invest. For instance, like Nokia, it was a very good company and it didn't invest, and it lost a lot of market value, essentially. So yes, you can lose your entire investment. But in the next slides, we will have a solution for this, how we can not eliminate risk, but minimize risk as much as possible. And the third point, lack of guaranteed returns. Yes, nothing is guaranteed in this life. So not even, for instance, this webinar, I mean, you can plan and maybe something happens. If, for example, now I'm currently working and I don't know, the electricity goes out. I hope not, so that we continue, but nothing is guaranteed in this life. So even when you see an advert and they tell you, yes, this is guaranteed, but you have to ask always. So what's guaranteed? Basically, that we are not programmed to live forever. So that's guaranteed, yes. But apart from that, I'm not sure what is guaranteed. So for stocks, that applies the same. We now move to bonds. So this is another asset class. So first we discussed stocks. Now we are going to discuss bonds. And the difference between stocks and bonds is that while stocks, you become an owner of the company, bonds, on the other hand, is when you lend money to a company or to a government, essentially. So let me give you an example. Recently, the Maltese government, the government of Malta, issued some government debt, we call it, and not only the local government. I mean, wherever you are located, probably your government in your country issues debt. So basically, let's say I will have 10,000 and I will buy a Maltese government bond. And the bond will have some details like that it will give 4% per year. Let's say it will give 4% per year, and it will mature in 2030. So basically, in simple words, what that means is that I will give my 10,000 to the government to use it for whatever purpose. I hope that it will be used to do good projects for the country, for instance. The government will tell me that, not the government as such, the broker will tell me that this bond expires in 2030. So if we start today, we are 2023, the bond will give me 4% on my initial investment. So I receive interest every year, basically 4% for this example. And then when 2030 arrives, I will receive my 10,000 back. So 2030, I will receive my 10,000 back, but in the meantime, every year, I will receive 4%, basically interest. So with bonds, we are lending. It's very different from stocks. And bonds have a terminal value, meaning that they mature. Stocks, once you buy them, they won't mature unless you sell them. Even also bonds, you can sell them as well before maturity. So you can have that option if you want your money back before the bond mature, essentially. And here we are saying that bonds, as we explained, are debt securities where investors lend money to sovereigns in exchange for regular interest payments and the return of the principal at maturity. So the key points about bonds: the first point, they are more stable than stocks. Considered more stable? Yes, they are considered more stable because you have a schedule. So you have a schedule that you know where you are going to receive the interest. You are going to receive it every year, for instance, or it can be semi-annual or quarterly. Some are even monthly, but you have a schedule that you will receive 4% interest. Not like stocks. Stocks, you do not know whether the management will distribute dividends, for instance. It's highly unpredictable. The second point, different types. Yes, you have government, corporate, municipal. We can add emerging markets as well. So you have different. So for example, if I buy a Malta government bond, obviously as the name implies, it's government type. If I buy a bond of Apple, because Apple, I can buy the stock, become an owner. But if they issue a bond, I can buy it as well. So that's corporate because it's a company. Municipal bonds, usually these are in the United States. In Malta, we do not have, but municipal bonds usually are related to, I think, states. So every state can issue their bonds, essentially. In Malta, since we are a small country, we do not have that. Also, you can buy emerging market bonds, so countries which are considered emerging. So those are the main types, even though there are other types, like, for instance, but I don't want to complicate much, there are some bonds which are floating rate bond, for instance, where the interest that you receive is floating, is not fixed. So there are some variations, but here we are mentioning the plain vanilla bonds, which are the fixed income, essentially. Yes, the third point, risk and return vary based on issuer and term. Yes. So if I buy a bond of, let's say, a Maltese company, we would expect that since Malta is a small country, I mean, when you compare it, for example, buying to a bond of Apple, which is one of the largest companies in the world, we would expect that the interest paid on the Maltese company will be larger than the interest rate charged on the Apple bond. That's normal because the Maltese company is perceived as higher risk and has higher bankruptcy risk, essentially. Also, for instance, if you have the same company, let's continue to mention Apple, since we took that example. And Apple just issued, let's say, two bonds, one which matures in 2030 and the other one which matures in 2060. So the second one has longer duration. You would expect that the longer duration would charge higher coupon. So it will give you higher return, essentially, because you are taking more risk by accepting a longer term. I am saying that usually because there are anomalies in the market. I mean, I can avoid not mentioning them, but there are anomalies. For instance, let me mention, let's say currently, if you buy 2-year US Treasury, 2-year, the 2-year is giving a higher rate than the 10-year. When that happens, we say that the yield curve is inverted. It doesn't usually happen, and there's a reason why it happens. Usually an inverted yield curve, meaning that short-term bonds are giving higher interest rates, higher coupons. Usually it's a predictor of a financial recession. So that's why. But this is an anomaly. I mean, we could have not mentioned it, but it's interesting as well to know. So the benefits of bonds. Yes, so you have regular interest income. So that's why bonds are usually more popular with pensioners to supplement their government pension, essentially. They have lower volatility compared to stocks. Yes, we mentioned this because they have a schedule and you know exactly when you should receive your income, when the bond will mature, as opposed to stocks which do not mature and the companies are not entitled to give you a dividend. And the third point, yes, more predictable returns, especially for fixed rate bonds. Exactly. So if you bought a bond which gives 4% coupon, you know how much you are going to receive per year, essentially. The risks. The risks of bonds, you have interest rate risk. So interest rate risk essentially is if you buy a bond today, which is currently giving 4% return with the current interest rate scenario, but tomorrow the central bank of your country decides to increase interest rate. What will happen is when interest rate increase, investments do not like it. Why? Because basically people can put their money at the bank and make money on their bank account, essentially. So investments will have more competition. So if you have a bond which will give you 4% when interest rates interest rates, for instance, were 1% at the central bank, and the central bank increases that interest rate from 1 to 2, so doubling the interest rate, your bond, which was giving you 4%, will fall in value. And that's normal. But you can you will lose value if you sell it at that time. To avoid losing in value when you have a bond, you keep it till maturity. So if the maturity of that bond was 2030, if you keep it till maturity, you are entitled 100% of your investment back. So if you put 10,000 and the bond price fell because interest rates rose, and your 10,000 is currently worth, let's say, 9,000, you do not need to worry, because unless you do not sell it, the bond, and keep it until the maturity, in this case we are saying 2030, you will get your 10,000 back, your money back. The second point is credit risk. Yes, this is another risk. If you buy a bond of a high yield, we call it high yielding company, you are taking more risk. You can do more return, but you are increasing the probability that your bond defaults, essentially, that that company goes bankrupt. So credit risk is very important in bonds. In fact, whenever a bond is issued, the bond will have a credit rating, we call it. You will have, for instance, the top rated governments or companies will have AAA. less good companies will have a lower rating. So, for example, triple C. And if you have a D, basically the company is defaulted. So you would want to avoid that. But credit risk is very important before you invest your money in a bond. There are some investors who study companies, and they will study these companies who have a high probability of bankruptcy risk, for instance. And according to their conclusion, they will see that these companies will manage to get out of the current situation, and they will get a higher credit rating in the next couple of months or years. So those investors will probably buy companies who are risky because they will take a higher risk, and if they really believe in that investment, will get a higher return. The third point is inflation risk. Yes, as you know, with inflation risk, I also like to mention the time value of money. So let's say we continue using this example. I invested 10,000 euro in a bond today, and it will mature 2030. I will receive the same 10,000 euro. But as you know, the 10,000 euro today are much more worth than in 2030 because of inflation and time value of money. Of course, because you lose purchasing power over time. Yes, diversification. I think this is one of the most important slides in this presentation because it will help you a lot when you are going to invest. Probably you know about this, maybe you have a different term, but the concept, I'm sure that a lot of you will know about this. So diversification meaning, I put a quote. The first guy who mentioned don't put all your eggs in one basket was in this special Spanish novel, Don Quixote. Of course, he wasn't, I don't think he was referring for investments, but the saying don't put all your eggs in one basket is very important. So basically it is saying avoid concentration risk. Do not put all your money in one investment. And diversification involves spreading your money basically across different investments to avoid putting all your money in one company essentially. So very easy concept, but very important because this will help us to do a good portfolio basically. So other alternative asset classes. Let me go back, see whether, no, here we didn't mention, okay. So other alternative asset classes. So before we mentioned stocks and bonds, which are usually the most popular. Now here in this slide, I put real estate, commodities, and crypto. So real estate, we know about the physical real estate. So when you buy an actual house, but you can also buy real estate via investing in REITs. REITs are real estate investment trusts. And these companies, usually you buy them like you're buying stocks. But the difference that they have is they are classified as REITs because they have to distribute 90% of the dividends every year. So in order for a company, for a property company to be considered as a REIT, they have to, by law, they have to distribute 90% of the dividends, of the profits as dividends. Otherwise, if they don't do that, they will lose the status of being a REIT. So apart from stocks and bonds, we can invest in real estate. And of course, if we include real estate, we are diversifying, as we saw in the previous slide, the concept of diversification. Commodities, the second point, as you probably know, when we mention the term commodities, it encompasses, for instance, like gold, oil, agriculture. So you have the precious metals, the energy, you know. So, and these commodities, they are good to have for your portfolio, because during times of inflation, they usually perform better than stocks or bonds. So essentially, you need them there in particular periods, and that's why we try to do a portfolio which has different asset classes, because I see it's like a football team. You need a goalkeeper, you need an attacker, you need a defender, you need a midfielder. Or when doing a recipe, you need different ingredients for your investment portfolio to be prepared to be an all-weather portfolio, if we can see it that way. So whatever happens, you are prepared, essentially. Your investment portfolio is prepared. Cryptocurrencies, this is quite a relatively new asset class. Cryptocurrencies, an example of them is Bitcoin. So, I mean, to be honest, I'm not an expert about cryptocurrencies. In my portfolio, I had for a short period, because they are very volatile and they are very difficult for me. They are very difficult to understand how they work. So, but here I wanted to mention them because the young generation, they are incorporating crypto in their portfolios. As we are saying here, even though they are high volatility, it means high risk. There is also an element of very high return. And since it is a new asset class, there is some regulatory uncertainties, and obviously regulation will come as we go along, for sure, ultimately to protect investors, basically. And here we are mentioning that crypto, yes, can be used for transactions or a store of value. The main idea was for crypto to do transactions. So like Bitcoin, it can be a substitute for the euro currency, the dollar currency, the Japanese yen. So it's another currency. But some were using also, now I think many are using it as a store of value. So as an investment, basically. Other investment vehicles. So in this page, we are basically mentioning mutual funds and ETFs, exchange traded funds. So here we are saying that they are investment vehicles, but they are more like a holding structure. What do I mean? Meaning that when you buy a mutual fund or an exchange traded fund, the underlying holdings will be stocks, bonds, REITs, real estate investment trusts, commodities, crypto, for instance. So they are basically a holding structure, mutual funds and ETFs. So a holding structure of the previous asset classes that we mentioned. So real estate, commodities, crypto, bonds, and stocks, essentially. And the difference between the two is that a mutual fund does not trade on a stock exchange, while, as the name implies, an exchange traded fund trades stock exchange. So that is the main difference between them. Also, another feature, usually ETFs, exchange traded funds, are less expensive because mutual funds are actively managed. There will be a person, a fund manager, who will buy and sell the investments. So he will buy stocks or bonds, or basically according to the fund objective. And he will do the transactions with the aim of making money. Basically, he will try to make money for the investors who bought the mutual fund. The ETFs, there are actively ETFs, but it's a very small proportion. A lot of them are passive, meaning that they will track a specific benchmark. We will see this, we will go in more detail in the next slides, what I mean by benchmark. We have a slide dedicated to it. So the key points is that by buying mutual funds and ETFs, you will have instant diversification, meaning that by buying one instrument, that instrument can have hundreds or thousands of stocks, bonds, etc. So by doing one simple transaction, you eliminate concentration risk. So if you buy an ETF, an exchange traded fund, which replicates the S&P 500, and the S&P 500 replicates the largest 500 companies in the United States, by simplifying that, you have exposure to 500 companies. So you immediately diversify. You're not putting all your eggs in one basket. And as we said, the other 2 points we mentioned as well, that mutual funds are usually more expensive and mutual funds are actively managed. So I would like to ask whether there are any questions about the previous slides. If you prefer, you can write the question as well, perhaps. Maybe you prefer writing the question, or...
Desmond, we'll take the questions at the end of the session. We've got a lot
Okay.
of questions. Yeah, there are a lot of audience have been putting on the QA box. So
Okay,
we'll
very
have...
good. I'm glad.
Yes.
I'm glad. Okay, so we can continue for now, and we will do QA at the end of the session. So, active versus passive investing. This is basically, I always like to mention this slide because it was my dissertation for my master's, and I went into detail in it. So it is something which I think is very important, and it's of interest to all individuals who would like to invest. So active investors aim to outperform the market. That's why active. You are trying to do, you try to behave active. You are not just mimicking the market. So you buy and sell according to your research, to what you believe. That's active. Passive, on the other hand, you do not care about buying and selling companies which are doing best or which you think you are doing best, but essentially passive investing, you buy the market. Here I mentioned a few. There's the S&P 500, the Nasdaq, Dow Jones, Euro stocks. So the S&P 500 is a benchmark of the largest 500 companies in the United States. So by buying that simple investment, you do not care which companies are going to outperform, but you care about the performance of the S&P 500 essentially. The Nasdaq is another index which is from the United States, but it's more technology related. So there will be companies like Apple, like Tesla, Nvidia, those sort of companies. The Dow Jones is another index which is used in the United States. I think it is composed of 30, if I'm not mistaken. Then in Europe, we have the Euro Stock 600. There is the DAX, which is the German, and the FTSE. FTSE, the last one, is a benchmark of the UK stock market. So when you buy, if you do not want to actively outperform the market, you can buy one of these indices, and basically you will get market returns. And here I'm asking, which investment method performed best according to past performance? So if we go and check historically, which is better, active or passive? So here I'm asking, should we give money to a fund manager to take care of our money and does active investing on our behalf, or just buy an index and be passive? Now, just to let you know, I mean, my job is active investing, because we take these decisions on behalf of our clients who come with their money, and they will tell us, listen, we have this sum of money and we would like to invest. But so you would say I am biased in favor of active investing. But I can tell you the answer right now. Passive investing is better. So it is better to buy an index, usually, because active investing, so giving your money to a fund manager, usually, because of the fees involved, the fees do not manage to justify themselves, as we are going to see in the next slide. So data shows that actively managed investments tend to outperform their benchmarks, and the reasons can be because of the skills of the fund manager. It can be, but usually it's more point number 2. Usually it's more point number 2 because of the higher fees due to more frequent trading and the higher costs to pay basically the fund manager and his team, because obviously when you buy an active investment, there is a fund manager and he has a team which will do research on which stocks to buy. So of course, active management will be much more expensive. Also, active investments are usually less tax efficient, especially since they do more frequent trading. So research shows that passive investments are better than active ones. And here, I tried to do a screenshot. This is from a website. Let me check the, okay. This is from a website of, they are called SPIVA, so S&P indices. And here we are showing that the first part relates to United States and the second part relates to Europe. And if we take the first one, what essentially that graph or figure is showing us, that on a 10-year on a 10-year horizon, only 8.59% of the funds outperform the S&P 500. So what are we saying here? That from 100% universe of active funds, only nearly 9% managed to outperform the S&P 500. So the odds, the probability of outperforming an index, it is very, very difficult. I'm not saying that it is not possible, but it is very difficult. So common sense would probably tell you, listen, do not try to go for active management. Go for the passive management. So just buy the S&P 500 if you are in the US, or if you are in Europe, you buy, in this case, the S&P Europe 350, and you have a larger probability that you will do better returns. And this data, it is showing 10 years. So on the website, it's a very nice website. It's interactive because if you, if you choose different time horizons, you will have different results, but the probability of beating passive investments, it's usually very difficult. So how can we do passive investing? We can do passive investing by doing index investing, as we said. So index investing, we buy, if we are in the US, we buy the S&P 500 or the Nasdaq, or if we are in Europe, we buy the Euro Stock 600. If we are in Japan, for example, we buy the Nikkei. So it depends. You can also, if you are in Europe, you can also buy the S&P 500. So there's no harm of buying another index from another region. Actually, that's very good to have because you are diversifying even more. Why index investing? So you have low cost, and that's why it's usually a very good idea to do passive investing. You have low cost and very low fees. And diversification, as we mentioned. When you buy an index, you're not buying one company. You are buying, in the case of S&P 500, you are buying 500 companies with one transaction. So in the case of the Euro Stock 600, you are buying 600 companies. So you have that element of diversification. You do not worry if one of the companies is doing bad because you only have a small percentage invested and you have other companies to compensate. So example of the S&P 500, we mentioned that it invests in the largest 500 US companies and it aims to replicate the performance of the index. So here I took an example of the Vanguard S&P 500 because when we mention the S&P 500, the S&P 500 is an index. So in order to invest in the S&P 500, you have to find a company which has an ETF in this case, which replicates the S&P 500. So the Vanguard S&P 500 is just one. There is Vanguard who offer the S&P 500. You can buy the S&P 500 from BlackRock, which have the iShares. And there are many companies who offer this investment. So basically, you can buy it from different companies. It's the same result. Here we are seeing the returns of the S&P 500. So in the first figure, we have annualized, we call it the term. So if we see the 10 years, for instance, 10 years, it is saying 12.76% return, meaning that this investment, the last 10 years, it generated 12.76% per year. So it's per year, not in total for the 10 years. So it's very good return, 12.76 per year for the last 10 years. If we go to the 5-year, for instance, we remain in the first figure. it will show that for the last 5 years, the same investment generated 11% per year. 3 year, it generated 10.48. So, of course, depending on the time frame, the return will vary. If we go to the second figure, it is calendar year. So, if we look, for instance, at 2022, last year, the return was negative, 18% down. So you can see that even though in the first figure, we saw that for the last 10 years, we would have done 12.76 per year, that doesn't mean that you do not have down years in the meantime. So we have to understand that even though an investment on average gave us positive returns, you can have 1 or 2 calendar years which were down, and that's very normal. So nothing wrong with that. Yes, so here we are seeing the same investment. So if we look, I think it's quite small. What I'm going to do, I'm going to use my software to show you what I mean, because this is quite small. So this is the same investment, the Vanguard S&P 500. And here we are seeing 10-year, what happened. As you can see, when you invest, markets do not go up in straight line. So can you see the cursor when I move the mouse? Is it visible?
Yes, it is, Desmond. It is.
Very good. So basically, for the last 10 years, this graph, what it is showing is if we had invested 10,000 10 years ago, today the value would be 30,700 something. So your 10,000 would have become 30,000 in 10 years. But as you can see, someone who invested right at the peak here, so this was end of December 21, would be losing money in the short term. So it doesn't mean the same investment. Basically, it is important when you bought it, and the more time you had more probability that you're doing positive returns. So this is for 10 years. We can do 5 years as well. So 5 years, you can see here, basically, this decline was the COVID pandemic. Of course, there was a lot of fear in the market when it happened. So if for instance, someone invested here, but kept this investment, he would have done very good, essentially. But going back to the initial amount, someone who had invested 10,000 5 years ago would have done would have had today 16,000. So it's very good return as well. 3 years, it is more volatile. So the less actually time you have, you can see that you have more volatility. But still, someone who invested 10,000 in the S&P 500 3 years ago, today he would have 13,600. And the last one, perhaps, 1 year, someone who had invested 10,000 1 year ago would have had would have today 11,800, and I'm going to do 6 months because all of them were positive, and even this. So actually, we didn't have periods the way we did the data. We didn't have periods where an investor would have lost money if he started exactly from these points. But of course, when you invest, there will be instances where you would be losing. And that's completely normal. So this we did them. Yes, investment strategies. Investment strategies you have. You can be long term. So buy and hold for the long term. If, for instance, you have a pension investment, that's an example of this. And you can, when you do long-term investing, you have the power of compounding on your side. We will explain this in more detail. We have a dedicated slide. Then another investment strategy is trading, which is short-term, although it's not very investing, the strategies, you know. So one of the rules, so basically trading is buying and selling securities over very short time frames, and it is very difficult to do profit in the long run. And there is this rule, the 90-90-90 rule. This states, there is this consensus idea, whatever rule. This states that 90% of the investors who do trading short term lose 90% of their money. So from 100 investors, 90 of them lose 90% of their money in just 90 days. So you can understand how difficult it is trading. I'm not saying it is not possible, but the odds are heavily against you. And of course, it requires more active monitoring and studying technical analysis. Then there is, the last one is dollar cost averaging. For example, I have a pension, and what I do every month, I pay a small amount, let's say it is $100, €100, whatever. And every month I invest. So that's dollar cost averaging. And the advantage that you have when you do dollar cost averaging is that you buy investments irrespective of whether the market is doing well or is not doing well. And usually when you have a pension, for instance, pension product, it is set, it is automated. So the bank will do it for you. So once it is automated, you remove your emotions, you remove fear and greed. So you are not afraid when the market declines, you know? So it is done automatically. For the young ones, dollar cost averaging is the best to do because you are saving part of your salary and investing in the market regardless of the market conditions. So investment strategies, there is also value versus growth investing. Usually value are companies which are undervalued, usually are less popular, while growth companies are companies which have a lot of, there is a lot of expectations around them, like Tesla, Nvidia. So those are growth companies. You can have a portfolio of both. You can have a portfolio of value, you can have a portfolio of growth, or you can have a mixture. But stocks are usually categorized in either value or growth. And then you also have accumulator versus income investing. The main difference between these two is that you can select an investment which gives you income, or you can select the same investment which any income is automatically reinvested in that investment. So like that, you won't receive any income, but you are continuing to investing and you are taking advantage from compound interest. So for the young generation accumulator, for the young ones, it's more important to have, especially if you do not need the money. Whereas for pensioners, which depend on monthly income perhaps, they will usually go for income investing. Or you can have both, because you can do a portfolio where you say, listen, this portfolio, I want it as a pension, so I want it accumulator, but in the meantime, I want to do an income portfolio where I receive something every year, for instance. So, compound interest. Compound interest, you might be familiar with the idea, but basically, compound interest happens when you do not only receive interest on your initial sum, but you start receiving interest on your interest. So let's say you started with €100 investing, and after 1 year, you receive €10 return. So your new amount will be 110, not 100. So the interest in the second year won't be on the 100, it will be on 110. So you will be doing interest on the initial capital of 100 and interest on the interest gained of 10. So that compounding, as we are going to see, is very powerful. And you can have compound interest in both stocks and bonds, of course. Yes, we are mentioning in detail more information about compound interest, that it works like a snowball effect. And also, I'm mentioning here the rule of 72. Basically, the rule of 72, we use it as a rule of thumb in order to know when your money will double in value. Let's say that you expect that your investment will do a 10% return. So what you do, you take the 72 and divide it by the 10%. So if you started with 10,000, your 10,000 will become 20,000 after roughly 7 years. So that's basically something handy, a tool which is handy to have, essentially. Yes, how can we benefit from compound interest? So here, it is a little bit small, but the idea from this diagram, we did 3 examples, where the first example, Billy investing at age 15, the second one, Susan investing at age 19, and Kim investing at age 27. And all of them managed to generate the same returns. So 10%, all of them. But as you can understand, Billy started at 15 and he only contributed 3,000 for around 5 years, if I'm not mistaken. And he ended up with an amount of 1.6 million when he arrives at 65. Susan contributed a little bit more than Billy, but started at age 19. And at 65, she will have 1.5 million. So contributed more than Billy, but will have a smaller amount because she started later. While Kim, who started at 27, he or she contributed much and much more than both Billy and Susan. Those 3,000 per year, you can see that the contribution is much more. But at 65, the amount for Kim will only be 1.3 million. So this example, which I got from this book, very good book, The Automatic Millionaire, it shows why it is important to start early, basically, because compound interest will work in your favor. And if you have a chance to buy this book, I really and highly recommend it, because it's a very simple book, it's very easy, but it has big lessons. Getting started with investing. Yes, so first we kind of mentioned more theory. Here I'm going to start including an example how we can invest in real life, basically, and not just on paper. So I'm mentioning Vanguard here because they are one of the best companies in my view, but it can be with another company. It can be iShares, it can be Invesco, whatever. But Vanguard, it is one of the best companies in my view. They charge the lowest fees, and usually I live in Malta and I can buy Vanguard, even though it is a United States company. I can buy their investments. So probably it might be available in your region. So here I'm mentioning Vanguard, as we said, because it's a very reputable company and they offer a range of investment products, including one of the range is this multi-asset life strategy ETFs, which for beginners, it makes life very simple because all you have to do, you buy only one investment, and in this single investment, you have immediately a diversified portfolio. And as we are going to see, there is more than one investment. So, and there are 4 in total, and they are according to the investor risk tolerance, basically. And as we said, by buying just one investment, this doesn't mean you are buying one stock of a company. You are buying thousands of investments, but by accessing one ETF here. So it makes it much more easier and not complex at all. Yes, so this is the range that Vanguard provide multi-asset life strategy ETFs. And you can see, so there are 4 columns. We have the 20% equity, then the 40% equity, 60% equity, and 80% equity. So depending on the risk that an investor wants to take, so I mean, usually the most popular portfolio in the US is the 60% equity for the bonds, but that doesn't mean that you cannot go for higher or lower risk. But by buying one of these, let's take the 60% equity. So this means you are buying an investment which have an exposure of 60 equity, 60 stocks, 60 shares of companies, and the remaining 40 are bonds. So like that, you have diversification by asset class. Apart from that, the 60% equity, for instance, in this case, will be composed of a lot of companies. So you are not buying one simple company. Basically, you are buying the global market of companies. And how it works is like this. So the 60% equity, what Vanguard will do, they will check how much, for example, how much Apple, let's say Apple company. Apple, maybe it has, I don't know, 2% of the global of the global size of companies. So your 60% equity will be distributed among global companies. And of course, this will mean that you have thousands of companies, so your 60% is very widely diversified, even though you are buying one investment in this case. And the same applies for the bonds. So you will have 40 bonds and you won't have one company, but you will have a range of companies. And if you are interested in buying this investment, the first row, you can see it. It's called ISIN. ISIN, it's like the ID number or passport number that we have, but it's for the investment. And the first one is the accumulating share class, meaning that any income that the investment will pay will be automatically reinvested in the investment so that you can take advantage of the compound interest. So here you have the ISINs, you can look them up. Maybe you are interested in buying some of these investments. I wanted to highlight that I do not have anything to do with Vanguard, so I'm not promoting them. I do not work with them or anything, but because they are one of the best companies essentially, and because they have very good products in my view. Yes, here I am again explaining that they go from very conservative. So 20% equity is very conservative because it has lower percentage of stocks. Then you have the cautious allocation. So basically, I am going through these 4 columns and explaining in more detail. And as we said, there is one row. I think it is 1, 2, 3, 4, 5, 6. The 6th row, it shows the risk assessment. So the first one is the lowest risk. And the last one is moderate to high, is the highest risk essentially. So they are divided according to risk tolerance. Yes, you have these 4, and here they are explained basically. They are very similar, or what changes is just the allocation. So the more equity you have, the more return you can expect, and the higher the volatility, of course. Conclusion, lessons learned. I mean, the first part before investing, we always have to understand the basic concepts. That's very important. I hope that this webinar helped you a little bit more. Now, after concluding this, we will have Q&A session. You have to set clear goals. So, for instance, if you want to do a pension, you can start and you are, I don't know, you are 20 or 30 or even 40. 50, it's close to pension, but you can do it as well. So you have to start, you start small, you invest every month. If you want an extra pension, you know that probably the pensions of tomorrow, they won't be enough. First of all, because of time value of money, and because, as you know, quality of life, we hope that it continues to improve. So we will always need more money than what we have today, essentially. Yes, start small, begin with amounts you're comfortable investing. That's very important. Otherwise, you will be overwhelmed if you put immediately a large amount. Start early, as we saw in the compound interest exercise, why it is important to start early. Diversify, spread investments across different assets by buying, for example, the Vanguard will do it for yourself without doing anything. By buying one of those investments, you have immediate diversification. monitor and adjust, regularly review and rebalance your portfolio. This point, I mean, sometimes the more that you give notice, I know it's ironic, but the more you give notice sometimes to investments, it's counter, productive. Because if there is a bad event and the market falls and you see your investment going down, you will probably you will probably feel that you have to sell. So it's better not monitoring and adjusting on a regular basis. If you buy, as we said, one of these investments and you bought the 60% equity, the investment will automatically rebalance itself. When we say rebalance, since you have different asset classes, you have both equity and bonds, you will have periods where the equity will outperform. So let's say from 60, your equity will become 70 because it did well, and the bond will fall to 30. The investment automatically and periodically will again rebalance and put the allocation back to 60-40. So you do not need to adjust from your end. So that's a very good advantage to have. The last point, simplify your investments. Consider index investing like investing in S&P 500 or S&P Life Strategy ETFs. Yes, investments, like it or not, the more boring it is, the higher the success rates. I know that active investing and trading are promoted as they are more exciting. They might be more exciting, but we do investments to make more money. If we want to be more exciting, we can go to the casino and enjoy the time there. It's more exciting, and of course, probably you will lose money as well. But that's why I am mentioning that investments should be boring, because you just buy an investment and let it work on its own. Yes, the last slide that I have is a quote from Warren Buffett. So Warren Buffett, if you Google his name, you can find a lot of wisdom of his quotes. Basically, he is the CEO of a US company, Berkshire Hathaway, and basically, although he is an active investor, he is very honest, like this quote shows. So he says, in my view, for most people, the best thing to do is own the S&P 500 index fund. People, he's referring to the people who sell you investments. People will try and sell you other things because there's more money in it for them if they do. So they will tell you, no, an active investment is better because we take care of your portfolio, So this clearly shows that passive investing usually is better. There are times where active outperforms, as we saw, but the probability is very low. So that was the presentation, the webinar. I hope that you found it interesting. And any questions, we can start with the QA session, I think.
Thank you so much, Desmond, for that fantastic presentation. And I think our listeners and our attendees would have all their queries resolved. And honestly, I was wanting to be one of the participants in this webinar today, because being a finance person, I loved how you went across the minutest details of investments and what are the different avenues available, what are the different advantages and disadvantages in each and every avenue of investment, and how it's important to start early and invest that minutest penny that might be lying in your wallet down there. There's no specific amount with which you need to start investing. There's no specific age as such with which you need to start saving. So the art of compounding is something that people do try and realize the impact of the same at a very later stage of life. So moving ahead with the questions that we have, there's one common question that is popping up in the questionnaire boxes is there any specific amount or any specific age as such at which the investors can start investing? And what are the good qualities to be investing? What are the good qualities in a company that one might be seeking out to where they can invest?
Okay, regarding amount, it varies from one person to another. I would more mention what percentage rather than amount, because of course there are people more wealthier than you and there are people less wealthy than you. So I would more mention a percentage. Now, I mean, different persons have different lifestyles. Even, for example, my friends, let me compare my friend with me. The fact that I work in investments and I know how much it is important, usually I will save a larger percentage of my salary rather than someone who works in a totally different field. So, this question, I mean, I try to save 20% per month of my monthly income, but that doesn't mean that if you save more or less, it is bad. Basically, you have to see what are your objectives. So, what I would do, first of all, if you are young, I would make sure that I have a pension, because as we said, we are not programmed to work forever. So, for example, if you save every month and you have, I don't know, 30 years for the pension to start, you have ample time. So do not discourage of starting small. So percentage is a specific percentage is difficult to say how much. There might be people, for example, who inherited a sum and who might not need that sum right now. So depending on their objective, they might invest it all, for instance, or they might invest part and the other part use it alternatively. So the percentage, if I had to be honest, I find it that you need to save 20% of your monthly income, because that way, after 5 months, you have a monthly salary. This is more personal finance, I think, but it's a very important question. And the second question, if I recall, was how do you select a company when you invest? If you ask me, and I work in investments, I analyze personally individual companies. I have to be honest that in my personal investment portfolio, I do not try to buy individual companies, and let me tell you why. So this might sound ironic, because someone who works in the financial industry, 10 years experience, and prefers to avoid individual companies. Because when you buy an individual company, you have to monitor the news, what is happening every day. Because the best company, a fraud might come out and it goes down 30%. So what I do passive investments for my portfolio and buy an ETF like the Vanguard Life Strategy. Just put money there, and irrespective what happens to a particular company, I won't be affected. Let me tell you why. Because those investments, since they replicate the market, they are self-cleansing, meaning those companies which start underperforming, let's say I bought the S&P 500, and today there is Apple, for instance, as you know, because Apple is a very good company. But let's say in 20 years, Apple will do a move like Nokia. It will do a mistake and starts underperforming. Once it starts underperforming and it won't remain one of the largest 500 US companies, the index automatically removes that company. So even though it is a passive investing, there is kind of a robot who's doing these changes for you. So, so by buying such investment, you can rest assured that probably you will do much better than buying an individual company. Having said that, you asked me how do you analyze an individual company? You can analyze by checking the financial statements, how much profit the company is doing. Apart from that, you have to estimate going forward. That's the tricky part, estimating, because today everyone knows how much Apple is doing if they check the financial statements. But going forward, will there be an earnings growth, a profit growth? What will happen to the technology sector? Basically, that's why there are research analysts. They will research the financial statements of the company, where the sector is going. Just to give you an example, when the aviation industry was something, which was coming into the market, basically, I think this was, I'm not sure, 60s, 70s. So the aviation market was booming. It was quite a new market. Someone who invested in the 70s in the aviation market made a lot of money. But as you know, today, since it became a normal market, it cooled down, and there aren't much opportunities. Actually, it's a highly competitive market, so it's not a good market to invest in, like automobiles, basically. So you have to remain updated on what is happening. If we are seeing that AI is going to be the next thing, probably the next Apple or the next Microsoft, it is in AI, for instance. So you have to study the market trends. During the COVID pandemic, a lot of companies like Zoom, for instance, they did well because for that period, they were in high demand. So apart from the numbers, you have to understand the story as well. Basically, you have to ask which companies are going to do a lot of money, a lot of revenue going forward. That's the question. But arriving to that is not straightforward at all. I hope that I answered.
Yes. I do hope that we have answered the questions really well. And also, I do agree that the stories that these companies do put out in the market is what need to be relied on, aligned with the numbers that the annual reports speak. It's only then you can make a good investment in a good company. So I'm compiling few questions together because it was targeted from underdeveloped and developing countries. So there were multiple questions questioning on how exactly should an investor's stance should be if their economy is not a developed one. It's basically an underdeveloped or a developing economy. So majorly, how exactly the investor stance should be there.
So very good.
An active investor or a passive investor, how exactly should that be?
Yes, very good question. If you ask me, for example, I do not have stocks of the local economy of Malta. So I invest globally. So it has a lot of advantages doing this way because I receive the salary so I'm highly concentrated in Malta. I have my house in Malta, my salary in Malta. So if there is, let's say, an earthquake, it's a risk, it can happen. I will lose my property, for instance, maybe I will lose my job, but at least my investments, if they are in companies globally, I am very diversified. I will go back to saying I shouldn't put all my eggs in one basket. I shouldn't put all my money in the local economy. So I would avoid, to be honest, investing if it is like Malta is our stock exchange is underdeveloped. There are, I think, less than 20 companies. So you cannot choose. You know, you do not have variation. You do not have companies like Apple. We mostly have banks and insurance companies. So even the business model is not very exciting. There aren't any companies which are interesting to have. So by buying like the Vanguard Life Strategy ETF, that investment will automatically, with one investment, you automatically have exposure to the global economy. Currently, if we go into the fact sheet is it's a document which provides you with more information about the investment. And before buying an investment, I think it's a good thing that you check the fact sheet. If you go into the fact sheet, you will see that the global market cap, we call it, the global percentage of shares is 60% United States. And it is not by coincidence, it is like that. It is because the United States has the most successful companies. And by buying such an investment, you can forget about it, and it will change the holdings accordingly. So if US companies, let's say they are underperforming, and let's say Asia is overperforming, the investment will start reducing the share towards US companies because their price would start falling in value, while the price of the Asian companies will start rising in value. So automatically, one is losing, is declining, and the other one is increasing. So like that, by buying such global ETF, you are rest assured that you are continuously holding the top performing companies, basically, because the investment will rebalance and adjust on its own. That's why it is a good tool for beginners, and I think even for experts, you know, because I mean, I discuss a lot this at work. Today, it's much more easier to invest with the introduction of ETFs. ETFs, for example, in the 70s and 80s, these didn't exist. They had to do a portfolio made of stocks and bonds. So there was a lot of risk, you know. But nowadays, with the introduction of ETFs, it's much more easier.
True. So we have all gone through various videos where they were specifically coming from India, Desmond, that investment in real estate is not a very lucrative one. So coming down to my next question, we have, which is from Aaron, who says that what could be the best foundation for real estate investment?
What could be? Can you repeat the question, please?
What could be the best foundation for real estate investment?
The best foundation. So, for instance, real estate in Malta is very popular. Let me tell you why. Malta is a small country, high density population. So you can imagine we do not have a lot of land. So we have a high density population, there is high demand and low supply. And in economics, the first lesson is demand and supply. So if you invest in a place where there is a lot of supply, usually you have to be more patient to make return. But if you invest in a country like Malta, which is small, a lot of people are coming here from Europe, because here we have, from 1 year, we have 300 days of sunshine. It's very nice weather in Malta. So it's, a lot of people are coming here. A lot of people are investing in property so that they rent. So basically the foundations, you have to have limited supply, like Malta. We have very limited where to continue building, to be honest. And there needs to be a strong demand, basically. I think that sums up real estate. To be honest, I like real estate and I have myself. So it's a topic that I like a lot. Real estate.
Like but it's very specific to the region where you are investing.
Exactly. So for instance, in Malta, I feel also there is the local bias when you buy physical real estate. I would buy in Malta, but let me mention another highly densely populated. I was reading yesterday that Andorra is a country in Spain. It's a small country like Malta, and they have a property bubble as well. They are facing the same issue, rising property prices. Even the conditions probably are similar to Malta, but I wouldn't buy because you have to understand the laws of that country. Spanish, I do not know. In Malta we go to the notary to buy. There I do not know. In Malta we have an architect. So probably you have to pay an agent. You have to pay him, so that makes it less attractive for you as well. So you have a lot of hidden costs there when you buy physical property. I know because I did it myself. And I have some rental property as well. So I really know the cost. But when you know the market and when having physical property is best, I live, I don't know, 15 minutes far from my rental units. So if something happens, I can go. But in other countries where, I don't know, I think you mentioned India, if it is far, how can you manage? And you have if you have a problem with tenants as well, because they will give you the return, you have to make sure, so it's what I can say to this person is that if he interested in buying property, he can also consider real estate investment trusts. There are these investments and you buy them, and the return, they have to give 90% of the profits every year, and the return will be rental income basically. So you can do it that way, and you will avoid managing the property yourself, because time is money as well, and there are a lot of hidden costs, trust me. So I hope that I gave him a good overview.
Yes. And also, I think you have ticked all the check boxes of investing in the right manner and not to depend on one source of income and have multiple sources of income. So coming back to a second last question, Desmond, which comes down from Felima, and she asks, how authentic are the stock index trading, whereby a middleman does the trading and pays you the interest as agreed? So how reliable is such kind of trading?
Very good question. So basically, in order to invest, you have to open an account with an investment company or a broker. You have to make sure that the company is licensed to buy and sell for investors. So basically in Malta, for example, I have an account with a bank in Malta. They invest. So you pay 10 euro per trade. This is a very small fee to buy and to sell. So first of all, the foundation is make sure that you open an account with someone who is licensed to act as a broker, an investment broker, or a bank, whatever. So that's very important. Then, once you have an account with a reputable company, because you cannot open an account with Vanguard, you have to be from the United States. As a European, I cannot open an account directly with them. I can buy their investments, but through a broker. Then once you have an account, a brokerage account opened with a licensed company, you can see what investments they have available. And of course, by understanding more investments, now we know that index investing, it's much more a good idea. So buying the S&P 500, for instance, or the Nasdaq makes a good idea. You can buy it on their platform or from their office. It depends how they operate. But it's very important that they are licensed, because you don't, I think there were instances where people invest money with third parties and they run with the money. So you want to avoid that. You want to make sure you're investing with someone who is licensed, and is there to do that job, basically.
Thank you. Thank you so much, Desmond. And due to the paucity of time, I would be heading to my last question. We have many questions which are talking about specific technicality relating to bonds. We have questions which talks, and there are questions where the participants are requesting you to recommend few investment options for them. But coming down to my last question, the learners and the listeners would want to ask, how exactly can you invest in overseas investments? So say, for example, if a person is in Africa or in India or in America as such, and if, like you said, if you want to invest in Vanguard, so how do they go about it? How exactly do you take that investment out?
Exactly. So I'm from Malta, as you know. What I did, what can be done, you open an account with a licensed company. So as we mentioned, I opened an account with this bank in Malta. And basically, once you have an investment account, you can invest in the investments that they provide you, basically. So they will give you a list, and from that list, you can choose which investments you want to invest in. But you have to make sure that the company is licensed. If in your region, I don't know, it's difficult to access a company which provides investments, today you can find companies which are online. I do not advise it, because I prefer going to their branch and speaking to them. For example, if they require some documentation, because to open an account, they will require your ID or passport, utility bill, and because regulation, because they have to check, they do the onboarding. So I would prefer if the licensed company is close to where I live, basically. So as I told you, I opened an account with a bank in Malta, and Malta small, so it's only 20 minutes from where I live. I can do an appointment and go there. If there isn't a company close to where you live, you can open online as well, and you can coordinate with them. But my only worry is because these online companies, I'm not saying they are bad, but let's say they will require a document and they will freeze your account until you provide. I would be more comfortable if they need something, I go face to face. You know, there is the human touch, because if they are online and they freeze your account, I would panic, to be honest. You know,
So would
because
I.
I heard stories where they make it difficult because you didn't provide, you know. So my suggestion would be, try to find someone which have offices in your region, you know, and perhaps if you like the job as well, maybe you can join the company as well, if you know. So especially if you liked this session about investments. So joking aside, but I would prefer someone who is close and I can visit physically. You know, that's my advice.
Correct. And also, I think the physical proximity to the financial institution in which you're relying so much is something that comes psychologically. It's something, a very basic requirement for investment. So, Desmond, if you would have a look at the comment section is overflowing as to how this webinar has been so fruitful for our participants. They have enjoyed the session so thoroughly. The whole presentation has been so insightful for them, and our deepest gratitude to you for accepting the invitation to come and speak at this rendezvous and enlightening us with such a fantastic session. Thank you so much, Desmond.
You're too kind. I mean, I really enjoyed it. So I hope that it was beneficial, and thank you so much for your kind words. I mean, they really mean a lot.
A special thank you to my co-panelist, Dr. Shrutika, and our head of the department, Dr. Sri Lakshmi, for accommodating this rendezvous session and giving us that source of encouragement of doing it every time. A special mention to the ACADS team and the admin department for helping us out technically. And Vandana and Ashwin, thank you for being the pillar of support for our every session. Thank you so much, everyone. Thank you for participating in this wonderful session.
Thank you so much, everyone. Thank you, Dr. Priya. Thank you.
Thanks a lot. Thank you.
Thank you.